Jared Dillian. Own your money, own your life.
I'm Jared Dillian. This is the Jared Dillian Show. We're going to be talking about the return assumptions that you have for your portfolio, which sounds boring, but is not. If you want to call to talk about your money, please call 844-305-7800. That's 844-305-7800. This is the Jared Dillian Show. I don't think anybody would accuse me of being most likely to succeed right now. Actually, the one thing is, the best thing in the world is to be underestimated. The best thing in the world is to be underestimated and to exceed expectations all the time. I've done that my entire life. Now, I want to talk about the stock market here for a second, because I am starting to get a little nervous about the stock. And I'm always nervous, right? Like I'm kind of the cautious, bearish guy where I'm never really happy. So I'll just put that out there. But things are getting, I watch some technical indicators, pretty sophisticated technical indicators, and they're kind of suggesting that we're putting in the top. Probably the most significant thing I saw today was that the very, very low end of the corporate bond market, so the low-rated bonds, the C-rated bonds, are getting slaughtered. And this is not a good sign. Oh, not a good sign for a bunch of reasons. First of all, basically low-rated debt leads everything. It leads the bond market. It leads the stock market. Back in 2003, I made a fortune buying this mutual fund that was kind of these busted converts and high-yield bonds that were like C-rated bonds, just garbage, just real junky stuff. And I made like 40% in a year on that. I mean, that was incredible. Like, this stuff leads into a recession and out of a recession. So when you look at C-rated debt and it's just falling apart, I'm like, oh no, like here it comes. So be careful. Be careful. I mean, now what I will say is that if you are investing on a periodic basis, if you invest $500 a month and you have an automatic withdrawal set up from your checking account, then by all means, keep investing $500 a month and do this for the rest of your life. The only time this gets to be a problem is when you're close to retirement. If you're 60, 65 years old, and then there's a lot at stake, and you're not going to be able to recover from those kinds of losses. And hopefully, if you're in your 60s, you're in a portfolio that is mostly bonds at this point. Hopefully, you're in a portfolio that is less risky. I'm a bit concerned about this. I am. And I do want the main thing I want to talk about here is return assumptions. And what I mean by the word return assumptions is kind of a fancy word. But what I mean by that is, when you invest in the stock market, what kind of returns do you think you're going to get? See, a lot of people have very unrealistic return assumptions. They say, well, I'm going to get 20% a year out of the stock market. No. Nothing gives you. I mean, you might have a year where you make 20%. You might have a year where you make 30%. You might also have a year where you make negative 30%. On average, it works out, or at least in history, it's worked out to about 8% a year on average. So how does that sound to you? Is that sexy? Is that exciting? I mean, 8% a year is a pretty good return. It really is. You can double you can double your money in like 7, 8, 9 years on that. So 8% return is pretty good. Now, there's some people running around out there who, for whatever reason, I don't know what the motivation is, they tell people that they can earn even more money in the stock market. Like, they say that you can make 12% in the stock market. And that's not true. And I don't know why you would tell somebody that. It is a falsehood. It's not true. You cannot. The average return for the stock market over the last 100 years is not 12%. It's 8%. I don't know why somebody would say it's 12%. Maybe if they say, well, it's growth stocks, small cap growth stocks have made 12%. Great. Then small cap growth stocks have made 12%. The stock market has not made 12%. So don't be dicing mouse turds over this stuff. It doesn't make 12%. Here's the answer. Like, we know what the stock market has returned in the past. Simple math. We don't know what the stock market is going to return going forward. So a lot of people say, well, it's returned 8% in the past, so it's going to return 8% going forward. We actually have no idea. We have no idea. And this is why when you look at a mutual fund and it has the 1 year, 3 year, and 5 year returns, then it has that disclaimer. It says past performance is no indication of future results. So we have 100 years of data that say that the stock market returns 8%, but past performance is no indication of future results. The next 100 years could be zero. The last 15 years in Europe have been zero. 15 years of zero in Europe. What if you're like sitting around in Italy and you have your money in the Eurostox index, some Eurostox index fund? You have not made any money in 15 years. What would happen if that happened in the United States? What if like these people in Missouri and they have like no returns for 15 years? Like people would actually be mad. Like we're accustomed to the stock market just puking at. I mean, Trump is he's with the stock market. He's nuts. He's absolutely nuts. He's obsessed with it. He wants it to. I mean, he considers it to be his report card, and it's really not. That's not necessarily the best, grading system on how his presidency is doing. First of all, because most of the wealth in the stock market is held by a small amount of people. So, I mean, yeah, a lot of people do own stocks, but like 93% of it is owned by 10% of people. So I don't think that's the best measure. And yeah, I mean, I will say if you're a bad president and the stock market goes down, then that's kind of a report card. But the stock market goes up for all kinds of different reasons that have nothing to do with Trump. And one of them is this idea that we just have a smaller supply of stocks. So there's less publicly traded companies. They're buying back their stocks. There's a smaller supply. We have practically infinite demand, and the stock market goes up. Having said that, I mean, tax reform was a real catalyst. Tax reform was a real catalyst, the tax reform of 2017, because if you cut corporate taxes, there's more income available to shareholders. It's simple math. And so the stock market should have gone up about 40% after tax reform, and it did go up about 40% after tax reform. Did exactly what it was supposed to do. Cutting taxes is pretty much always good for stocks. Always. Especially corporate taxes and investment taxes, so dividends and capital gains. The last time I saw the stock market go bananas on a tax cut was in 2003 when Bush cut the tax rate on qualified dividends to 15% and the tax rate on capital gains to 15%. The stock market went bananas, went straight up. Anyway, back to unrealistic return assumptions. We're not making 12% a year. We may make 8% a year, but we really have no idea what we're going to make in the future. And the reason is, this is tiresome. The reason is that the conditions that led to prior returns may not be present for future returns. So America has had the best performing stock market since forever. We've had the best performing stock market. Why is that? Why are we the best? Well, because we have the rule of law, we have property rights. I mean, we have these protections. We have capitalism. We have a free market system. We have sort of light touch regulation compared to some countries, although it's picked up in recent years. But yeah, like we have all these things, and we have a good environment for stocks relative to some countries. And that may not be present in the future. Like, for example, if Bernie Sanders becomes president, I am comfortable saying that returns on the stock market for the next 30 to 50 years are going to be lower and might be negative. I am comfortable saying that. And I'm also comfortable saying that politics has an influence in all of this. I mean, the Great Depression lasted like 17 years. Okay. One of the reasons the Great Depression, I mean, the New Deal didn't rescue us from the Great Depression. It actually made it worse and made it longer. an economy will recover if you leave it alone. If you go back to the recession of 1917, I don't know, it's a long story, but the point is, we don't know what kind of returns we're going to have in the future. We just don't, which makes it impossible to plan. How can you plan for your retirement if you don't know what you're going to make in the future? I mean, you can plan for 8% returns, but that influences how much you're going to save for retirement. So if returns are less, then you should actually be saving more, which means you should probably be saving more. You might be saving 20% of your income or 10% of your income and think that's enough because you think we're going to get 8% returns. You should probably be saving more because my guess is that returns for the next 100 years are not going to be as good as the first 100 years. And part of that is demographics. Part of this is just population growth. When you have population growth, when the population is expanding, you have more people working, you have more output, you have better productivity. Like there's more GDP. Stocks are a function of economic growth. Population growth means higher stocks. Look at Japan. Their population is declining. Top of their stock market was in 1990, 29 years later. They still are not back to where they were before. So anyway, we don't know what the stock market is going to return going forward, so you should be excessively conservative when you save. I'm Jared Dillian. This is The Jared Dillian Show.
The Jared Dillian Show.